Hi, I'm Max Keiser. Welcome to On the Edge. Let's get right to it and go to Washington, D.C. and talk with Ed Harrison of CreditWriteDowns.com. Ed Harrison, welcome back to On the Edge.
Good to be here, Max. Been a long time.
Yes, it has been too long, and we trust you to bring us all kinds of insights into the credit markets. Your website, CreditWriteDowns.com, is a must-go-to site for anyone interested in the credit market. Now, here's a headline from this week's papers. Eurozone pushes for tougher policing of Greece. Now, Ed Harris, how is this anything but a very aggressive act by these banking interests? I mean, they're saying that they're going to start to manage Greece's interests. What's going on here?
It's ridiculous. It's basically the Roland Berger bailout for the banks. What they're basically saying is this. The Greeks, they've played these games, these shenanigans for too long. Now it's time to put the screws to them. And that means that if they are going to try to default, when really they should have made every effort to pay instead of running up debt and allowing their taxpayers to fleece us, we are going to grab their assets and sell them off in order to make good on their debt. It's like debtor's prison, basically. It's as if someone came into your house and because you couldn't pay, they took your car, they took your television, they took your mobile phone, they took your sofa, your bed, etc. That's really what they're trying to do.
Right, but Ed Harrison, this is a country, this is a sovereign country, and they had a constitution, and in the constitution it says quite clearly that if debts can't be paid, the country must default to preserve sovereignty. How did the Troika get the Greek government to agree to the quote-unquote memorandum which gave the Troika, that is to say the IMF, ECB, and EU, powers greater than the country's own constitution? How did that happen?
I have no idea, and I don't really think that this is definitely going to happen. At a minimum, I would expect at some point down the line, this government, the socialist government, I should add, is going to lose power, and the Greeks will revolt. They won't allow stripping of their assets and giving off to interest. I mean, it would be one thing if these were private interests within Greece. That would be one thing in terms of privatization. But these are obviously going to be foreign interests which are going to be owning Greece. So it's basically a sale of Greece to foreigners.
All right. Now, unnamed officials are quoted as saying that the European Commission needs to, quote, take over some of these sovereign functions of the state of Greece to, quote, get the machine running. In this case, the machine that they're referring to, of course, is privatization of national assets, putting national assets into corporations' hands and bankers' hands. And this is not dissimilar to a leveraged buyout we used to see, going back to the 1980s on Wall Street and the corporate raiders and carrying on through this day. You're using, because the IMF and the EU and the ECB are themselves bankrupt. So they're bankrupt to begin with, but they are able to arrange loans from a coterie of corrupt bankers on the world stage to take over Greece, sell the assets, and then pay down the borrowed money to begin with, even though they themselves are bankrupt. Isn't that a good description?
Well, I don't know about whether they're bankrupt or not. Obviously, Christine Lagarde, she's going to take a different view, and she's saying that the IMF doesn't need more money. But let me put it a different way. Basically, here's what's happened. Is that around the world at various points you get these credit crises, these banking crises. And what happens then is that, the banks are inextricably related to the economy and to the sovereign. And so when these banks fail, the government feels forced to take over their liabilities, bail them out. And obviously what then happens is that the sovereign is imperiled as a result of that. And then they have to figure out what they're going to do. And in past times, what you've seen is the entire banking systems of these countries go under to foreigners. One of the reasons that you have the Eurozone crisis at all and the European debt crisis is because a lot of these banks, Sweden and the Baltics, Austria in Central Europe, they basically own the banks in those countries. And as a result, when these countries get into problems, the banks want to be bailed out, and they're essentially bailing out the banks from these foreign countries. And so you have a typical conflict of interest here. The government being dictated by banks which are foreigners, and it's not in the national self-interest.
Right. Just review that again. Make those points again, just to make sure that I understand what you're saying, and therefore my viewers understand what you're saying. The comparison that you're making, break it down a little bit more for me.
What happens is you have a financial crisis. Banks get into trouble. At that point, they're either rescued, that is bailed out, or they're allowed to default and their creditors take a hit. Usually what happens is that they're bailed out in some way. And oftentimes what then happens is the sovereign gets into trouble as well. And so at that point, the sovereign has to make a call. What are we going to do? Are we going to privatize our assets, including the banks that we actually now own, or are we going to default ourselves? And usually what happens is they privatize those assets. Assets, including the banks themselves, fall into the hands of foreigners as a result of that. This is what's happened time and again in Eastern Europe. It will probably happen in Ireland. And we're seeing a version of that happen in Greece as well.
Okay, I understand what you're saying now. What confused me, though, is when you're saying that the country decides to privatize the assets that are now held by the bank due to the crisis that is transferred to the sovereign, but they're acting in the interest of outside banking interest, outside countries. So then you have this huge conflict of interest. And, not a lot of people have been talking about Ireland so much recently. What's your take on Ireland currently?
Well, I think Ireland's further along than, say, Spain, for instance, in terms of dealing with their problem. I look at Ireland as having been the closest to the Swedish solution, so to speak, in terms of dealing with their banks. Basically, they wrote down in most of the write-downs they took. As a result of that, they had to nationalize these banks because the banks basically had first of all, they had no equity. But really what they should have done is told the bondholders to take a hit as well. In Sweden, they didn't tell the bondholders to take a hit either. So ultimately, some of these banks were getting nationalized. In Ireland, because the banking system was so large, the nationalization of the banks created an enormous debt problem for the Irish government. So whereas in Sweden 20 years ago, these banks remained within Sweden, what's going to happen in Ireland is that these banks are probably going to be taken over by foreigners. And we already saw this with Bank of Ireland. A Canadian company just recently bid a large percentage of Bank of Ireland, basically making Bank of Ireland more of a foreign company than a domestic company. And this is what you should expect as the Irish government tries to get rid of these banks, offload them, and reduce its debt.
Right now, just to give a really broad picture on this, but to tie together with the credit crisis, let's do a compare and contrast, Ed Harrison, with Iceland, because it is similar but different. Tell us about it.
Well, in Iceland, it was exactly the same thing as in Ireland in terms of two big banks to bail out, being taken on by the sovereign government, supposedly. So the three biggest banks in Iceland went under, the government took it over. The people then saw that this was a complete farce and that they didn't want to therefore be on the hook for the debts of three corporations that, they never voted for. And so they voted against paying back the debts that these banks owed. And as a result, Iceland was shut out of the markets. They had a deep inflationary depression, and they're now recovering from that, but without having the debt associated with the banks. And Ireland, it's different in that they actually are now going through the process of loading themselves up with that debt and making sure that their citizens, therefore, will be on the hook for that debt for a long time to come. And the only way to get around this is austerity over a longer period of time, and also privatization, bank sales. That is, to sell these banks to foreigners and potentially to sell assets other than the banks to foreigners as well.
Now, I want to talk about this Occupy Wall Street movement for a second, but put it into context in terms of what you've been talking about and what you write about over there at creditwritedowns.com, Ed Harrison. For the last 20 or 30 years, the banking industry has become a bigger percentage of the GDP of the G20 nations, to the point where you have this too big to fail phenomenon, and the bankers have enormous leverage over the policies and the politicians of these countries. Then you have Occupy Wall Street. They are identifying the bankers as the problem. So my question is, obviously we need banks on some level, but we don't want banks to be 50 or 60% of the GDP like you see in the UK, for example. So is there a sweet spot where if you looked at the GDP, you would say, well, the banking sector accounts for X percentage of GDP, and that's a healthy level, Ed Harrison?
Well, that's a good question. I'm not sure what that level would be. I'm just trying to think about countries where the banks, generally speaking, are not too big to fail, where they have a good mix. And I'm having some difficulty because basically you look at Spain, they're in big problems. France, they have too many too big to fail institutions. You look at the Netherlands, same thing. Belgium, same thing. Sweden, also the same. Basically these banks, they've loaded up on cross-border assets, and as a result of that, you could say in a sense they've colonized the banking systems. A lot of other countries taken on a lot of other assets, loaded up, leveraged up, and as a result, they're all too big. I'd say across the board, banks are too large as a percentage of GDP across the entirety of North America and Europe. One of the banking systems that you can look at that it has so far done well, partially because of regulatory control, but also because they have had a housing bubble there that hasn't popped, is Canada. And Canada is dominated by 4 large banks. If they were to get into any problems, of course, all 4 of those banks would be too big to fail as well. So I don't think that there are any examples that I could actually give which show, in fact, where we are across the board. These banks have become too large.
Right. And of course, Canada is tied very closely to the natural resource sector. And they also went through a huge crisis in the early 90s and had to recapitalize and nationalize. So they're benefiting from the crisis that preceded the current crisis to some degree. So possibly they're just a little bit different point in the cycle. But let me ask you a question. If it's hard to determine what percentage of GDP the banking sector would be for a healthy economy, let me ask us in a different way. Is there a Fed funds rate? Is there a rate that the Federal Reserve banks should maintain and not go below substantially to maintain some kind of equity in the economy to keep banks from growing too big? Because they get big when interest rates are artificially low, and this basically opens the gate for the banks to become a huge part of the economy. Is there a natural rate that would keep banks in check but still keep the economy going forward?
Well, I think the natural rate is the rate that's set by the market. I mean, when you look at the Fed funds rate or any policy rate that's set by a central bank, basically what you're saying is that we were going to allow central planning by a central bank of interest rates, a very important component of the economy. I think it's completely ridiculous to expect a group of 12 individuals to understand what the rate is that is best for the economy at all times. They're obviously going to make mistakes. And to the degree that they are wanting the economy to go forward and to not skip a beat, they're going to make mistakes that are going to to the upside. That is, they're going to want the economy to go forward and keep rates too low for too long. That's exactly what we've seen over the last 30 years. So, central banking in terms of setting the policy rate, setting the Fed funds rate in the United States, it's the market should set the rate, not the central banks.
All right, let's walk through that in a practical way, in a practical application. Let's say the Federal Reserve is disbanded in the United States, for example, and then you have somebody like a Bill Gross, who's the biggest bond manager in the world. He's got over $200 billion in bonds that he manages. And Bill Gross, and we know from his writing, he spends the most of his time trying to outguess or second guess the Fed into determining his mix of bonds. But if he got rid of the Fed, then Bill Gross would simply be buying 10-year treasuries based on his outlook for the economy as a whole, and then depending on his actions that and others and all the bond managers in America and around the world, their combined actions would create a price for that 10-year bond and a commensurate yield for that 10-year bond, and then that would be the interest rate around which all the mortgages, credit cards, certificates of deposits, everything is pegged to that rate. That's a market rate. So on a practical basis, that's what would happen, right?
Well, let me break it down in three parts. Okay, this is basically what's happening. For the most part, the Fed is out of the market except through quantitative easing of longer dated treasuries and other securities. So the market sets those rates. Basically, what happens is you have people like Bill Gross and others, buying and selling, and a market rate comes out as a result of their buying and selling. Now the question then becomes, what does that market rate represent? That market rate represents the view of what future policy rates represent. So in the future, the Fed will say have rates at 1% or 2%, et cetera, and you can extrapolate, you can bootstrap a yield curve based on these future policy rates to get you to the 10-year rate that you see in the marketplace. The question then becomes what happens in that overnight, that very short-term rate. Who sets that and what rate is that? That's where the question is. That's the third part of it. And what happens now is that the Fed says we're going to defend a certain rate, let's say 25 basis points, 0.25%. And what we're going to do is we're going to buy up reserves or sell reserves enough in order to keep that rate, irrespective of what happens. What I'm saying is that what the Fed should do is that they should not defend a specific rate. They should let the rate fluctuate according to what the market participants want. And the only way to do that is for them to stop setting rates and to start focusing on the reserves. They can focus on an amount of reserves, whatever it may be, but they should definitely not focus on the rates. They should let that be market determined.
So the point being that the 10-year rate is not the key rate upon which you build your economy. It's the short rate, as you're making this point. It corresponds to the Fed funds rate, and this is the rate that most often is associated with the Federal Open Market Committee. They meet, they determine this rate. It's near zero, and that's a huge controversy. Now, if we go into, so putting aside money managers like the Bill Gross for a second, we look at that short rate. That short rate, if it was purely market-driven, would be determined solely by the supply and demand of 30-day Treasury notes as tracked by all of the market action to buy or sell 30-day Treasury notes in the marketplace. So all of the people who save money, for example, the savers out there, they are interested in, of course, buying yield. They want return on their cash. So their interests are reflected in that interest rate. So they're naturally buyers of fixed income, and they're buyers of this paper. And then you've got those who are.
Well, Max, let me break it down a little bit, even more simply. Forget about the 30-day rate. Think more about the bank, the overnight rate. The market for bank reserves. If, let's say, you go to a bank and you say, I want a loan because I want to fund the Max Keiser show on my own, and I need a loan to do that. The bank will then, assess whether you're creditworthy or not, and based upon that, they will give you the loan. But then they'll go back in a separate transaction to their Treasury Department, and the Treasury Department will say, look, as it turns out, we don't have enough reserves to deal with that. We need to go out and borrow reserves in the interbank market in order to be able to have an adequate reserve requirement to fund this loan that we're making to Max. And so they'll go and do that. It's that market that I'm talking about. It's the market for reserves that the Fed is monopolizing by setting a specific rate, which obviously that rate is going to affect how many reserves are in the system because they control the rate, and based upon how many loans want to be made, therefore X number of loans are going to be made at that specific rate. If the rate were higher or lower, fewer loans might be made.
Okay, so is it also needed or not needed that there would be a general understanding in terms of what banks should have on hand in terms of reserves against loans. This is a big discussion with Basel III. This is a big discussion. Jamie Dimon recently was in Canada, jawboning a finance minister up there, or the current Canadian central bank minister, about not wanting to increase the rate of reserves banks should hold on their books. He wants it to be less because he wants the leverage. He wants the greater balance sheet. He wants that for his bank, J.P. Morgan. Is there a need to establish a minimum reserve requirement, Ed Harrison?
Well, I think the question that Jamie Dimon brings up is really more about capital than it is about reserves. In a free-floating currency system that is not convertible into anything like gold, basically banks are not reserve constrained. So they, as I was just saying before, they can actually go out and borrow reserves in the interbank market. What constrains them in a place like Canada, as an example, where they don't have a reserve requirement, is their capital. And I think that's what you're talking about, and what Jamie Dimon is addressing, is the fact that they can leverage up their capital to a certain degree. And the question is how much should they be allowed to leverage up? You have people like Simon Johnson who are basically saying that they should only be able to leverage up 4-to-1, 5-to-1. So they should have 20% equity capital in order to make sure that they're well-capitalized institutions. And, of course, that means that they're going to have less money. The more leverage you have, the more you can win, but also the more you can lose. And, when it's a heads I win and tails you lose phenomenon, meaning the banks get bailed out when they lose, they're going to want to leverage up. So this is a bad thing as far as the banks are concerned. They want more leverage, and we, as taxpayers, want less leverage.
Okay, well, Ed Harrison, we have to stop there because we've run out of time. I wanted to spend this show, though, looking at some of the mechanics of the banking industry itself, because suddenly this is the topic du jour of this global Occupy Wall Street movement when they talk about the banks. Let's talk about what banks do in terms of capital, reserves, interest rates, etc. So thanks for adding some light to this, Ed Harrison. And once again, thanks for being on The Edge.
Thank you very much, Max. It's good, and I hope to come back soon.
All righty. Well, that's all the time we have for this week on The Edge. I want to thank my guest, Ed Harrison of CreditWriteDowns.com. Now, you can follow Ed on Twitter. His Twitter handle is EdwardNH. If you'd like to send me an email, please do so at ontheedge@presstv.com. Until next time, this is Max Keiser saying bye, y'all.